By looking at the summary, Apple shows the fall of its liquidity position from 2021 to 2022. The current ratio and quick ratio are both poor and unsatisfactory. We can see Apple current ratio in 2021 are greater than 1, which means Apple has more current asset than current liabilities. Apple also able to pay for their short-term obligations or those due within 1 year. But in 2022, Apple current ratio decreased to 0.88 or below 1, which means Apple technically does not have enough asset to pay for all of its short-term bills. Moreover, we can see Apple quick ratio in 2021 is also greater than 1. It means Apple appears to be in a good position to cover their current liabilities because its liquid assets are higher. Hence, a higher quick ratio signals that a company can be more liquid and generate cash quickly. Meanwhile, in 2022, Apple may not be able to pay its current obligation because the ratio is below 1. As a result, Apple does not have the ability to meet all of the short-term obligations.
For the next slide, I want to explain to you the factors that affect the current performance of Apple's company for the year 2021 and 2022. The first factor is changes in revenue and profits. Apple had a successful year in 2021 with high revenue and profit driven by increased demand for their products due to the pandemic. The popularity of iPhones, iPads, and MacBooks and wearables such as Apple Watch and AirPods was due to their usefulness in online learning and remote work. Apple's reputation for quality and ability to adapt to consumer needs also contribute to their success. However, in 2022, factors such as ongoing pandemic, global economy, and changing customer preferences has affected Apple's performance. Second factors is product release or launch by Apple. In 2021, Apple also had the successful year with their product release. The iPhone 13 series had improved camera technology and performance, keeping Apple at the top of the high-end smartphone market. Upgrade to the M1 processor in MacBooks has improved processing power and software compatibility, while the M1 chip in the iPad Pro enhanced tablet's performance. The launch of the AirTag tracking device expanded Apple's ecosystem and attracted users looking for reliable tracking solutions. Overall, this product release contribute to Apple's successful financial year in 2021 and solidified their reputation for innovation and competitiveness. However, in 2022, Apple is expected to continue innovating with new release, but their success depends on consumer reception and market competitions. The last factors that affect the company's current performance is the growth in services. Apple services experienced significant growth in 2021 thanks to the popularity of subscription services like Apple Music, Apple TV Plus, Apple Arcade, and the App Store. The App Store saw increased downloads and in-app purchases, while Apple Music and Apple TV Plus gained more users. Apple Arcade's exclusive games attracted customers, and sales of accessories and wearables also contribute to service income. This service, which required subscriptions, helped Apple diversify revenue sources beyond hardware sales and reduce dependence on iPhone sales.
As you can see on the screen, my topic are factors that affect the effectiveness of company in managing its asset based on the two journal of SME company, which is Small and Medium Enterprise Company in Malaysia. In my presentation, I will focus on the two major issues, which are the financial management and management skills. My first point concerns on the financial management. Financial management is one of the most important aspects of a business. To start and run a successful business, you will need excellent knowledge of financial management. My highlight in financial management are investment, cash management, and also improve the profitability and value of the organization. What is investment? By creating real and safe investment opportunities, it will generate a profit and achieving a long-term financial goals. However, as a business person, we need to bear in mind that investment come with a different level of risk, either low risk or high risk. Meanwhile, the cash management refer to the monitor and maintaining the cash flow of the business. A business can fulfill the needs of its business activities and prevent taking on debt if it is able to generate good cash flow. The best way to monitor the cash management is need to record and track the inflows and outflows of money day to day or known as daily tasks. Also, it need to be recorded as cash flow statement to be reported to the stakeholder on a quarterly basis. And then improve the profitability and value of the organization. It based on how much money a business makes compared to how much it spends. In addition, it allows businesses to grow and compete with other businesses in the same industry. In order to increase profitability is carry out the market analysis. By conduct the market research, it will make business or company find out their target markets, also why they might purchase the goods and services. Next, I will focus on management skills. Management skills known as individual or an executive in the organization that need to have qualities or skills in order to perform specific tasks within an organization. It comprises the capacity to handle crisis issues, planning, making decision, which is conduct executive roles within an organization, communication skills, and problem-solving skills. The first one is planning. Planning is developing a plan of action or one or more strategies to pursue and accomplish particular goals or objectives using the available resources. The main reason is because without a solid plan, not much can be achieved. And the next one is making decision by acquiring information, making decision based on that knowledge, choosing the best decision making strategy at the correct time, and coming up with an effective solution. Decision making abilities help an organization evolve and consider how to improve its environment. The most important before making a decision is to decide on the resolution, benefits, and drawbacks. Other than that is, as a manager, excellent communication skills are essential. It can determine how effectively the information can be shared throughout a team, ensuring that the group functions as a cohesive workforce. Great communication skills can prevent misunderstanding. And the last one is problem-solving skills. A good manager must be able to confront and resolve the common issues that may come out throughout a routine day. When the individuals or manager has great skill on solving problem, it sets them apart from the rest of the team and inspires trust in their leadership abilities. And finally, the journal demonstrated that small and medium enterprise, which is SME company, have succeeded in managing their asset effectively.
The fixed asset turnover ratio measures a corporation's efficiency in using its fixed asset to generate sales. There are two strategies for improving this ratio. Firstly, is regular maintenance and effective management of fixed assets can increase their productivity and extend the duration of use. Taking care of and managing things like machine and equipment can make them work better and last longer. This can help the company make more money without spending a lot of extra money on new things. When things are taken care of, they work better and there are fewer problems. This means a company can make more things and save money. It's also cheaper to take care of things regularly instead of waiting for them to break and then fix them. When things last longer, the company doesn't have to buy new things as often. Managing things well can also help the company use its resources like people and power in the best way possible. Next strategy is spending in modernization and technology in upgrading fixed assets and investing in new technology can both significantly enhance with output and efficiency. In simple words, if we use better and never think in our work, it can help us to do more, do it better. For example, if we use new machine are cheaper to use, we can save money and make more things. We can also make our work easier and faster by using computer and robot. When we make our old thing better, it's use new technology. They can work together and make our work even better. This can help make smarter choice and be more competitive in our jobs.
As illustrated in the balance sheet provided, in 2021, the company debt ratio is 28%, which is lower than industry average ratio, which is 35%. This means the performance of the company is good compared to the industry. A lower debt ratio means a company is in good standing and likely able to pay back any of accumulated debt. Likewise, in 2022, the ratio is 32%, which also lower than industry average ratio. While a high debt ratio indicates that a company may have more debt than assets and is at financial risk. Next, we move to debt to equity ratio for year 2021. The company ratio is 53%, which is higher than industry average ratio, which is 43%. This means the company's performance is poor compared to the industry. Similarly, in 2022, the ratio is 55%, which also higher than industry average ratio. Therefore, a higher debt to equity ratio indicates that the company has higher debts, which business use debts to finance its growth. But a lower debt to equity ratio signals fewer debts, which means the equity of shareholders is bigger and does not require any money to finance its business and operation for growth. And the last one is time interest earned. In year 2021, the company ratio is 3 times, which is lower than industry average ratio, which is 4.1 times. This means the company performance is poor compared to the industry. But in 2022, the company ratio is 5.2 times, which is higher than industry average ratio. A higher time interest earned means that the company presents less risk to investors and creditors in terms of its ability to pay one's debt. Even so, a lower time interest earned could be at risk of defaulting.
As shown in balance sheet provided, the gross profit margin ratio in 2021, the company ratio is 65%, which is higher than the industry average ratio that is 60%. This means that the company's performance is good compared to the industry average ratio. Similarly, in 2022, the ratio is 76.5%, which is also higher than the industry ratio. This means a higher gross margin indicates that the company is running more efficiently and is more financially stable than other companies in the same business. But if the company is facing a low gross profit margin, it is a very worrisome situation because it can hinder profitability and negatively impact cash flow. For the net profit margin in 2021, the company ratio is 24.5%, which is lower than the industry average ratio, which is 35%. This means that the company performance is poor compared to the industry average ratio. As with 2022, the ratio is 25%, which is also lower than the industry average ratio. This means the company has a low net profit margin where it used an ineffective cost structure or a weak pricing strategy, while a high net profit margins means that the company can effectively control its costs and provide goods or services at a price that is much higher than its cost.
As an investor, we choose to invest in the company because based on the balance of sheet, company made many improvements compared to the previous year. There are 3 reasons why we want to invest in the company. First and foremost, the reason to invest in the company is because it has a high time interest earning ratio in the current years. It may expect to experience the convenience of arranging loan. As an investor, we may also be wary of the security or stock sale by a company with low interest earning ratio. At the same time, it can also help to improve the measurement of time interest earning easily by continuing to increase income or paying off debt. Next reason why we need to invest in the company is opportunity for competitive advantage. When the company maintain better performance ratios than its industry peers, it often signal a sustainable competitive advantage. This advantage can exist in the form of superior product quality, unique technology, efficiency, supply chain management, or brand strength. As investor, we can see as a sign of releasing against competitive pressure. Last but not least, the reason why we want to invest in the company is start facing competition and try to make improvement to the product time by time. This improvement can make buyer attract by and contribute to increase sale. As a result, there is the balance that profit will last in the long run.